mode.
Hello guys, hello everyone. Today's webinar hosted by Admiral Markets, Formation of Basic Chart Patterns. We will start with our risk disclaimer first, and after that I will give a microphone to Mr. Mikhail, who will just introduce you to edge and forex trading. So by accepting this risk, you go further with us and you will take all responsibilities for trading the capital. So guys, today we will have an important webinar. Be sure to stay with me because there are some chart patterns which are basic, and I will introduce you to the way how you can trade it. So if you favor price action and you can get it with a couple of indicators, you will see how you can trade those patterns. Now I will make Mr. Mikhail a presenter so he can start doing his introduction to edge and forex trading. Mikhail, here you go.
Good afternoon, ladies and gentlemen. Good afternoon to all the traders out there. I hope that, can you see my screen now? Okay, just give me 1 second. I'll try to fix the screen. Okay, can everybody see me okay now? Let's try some more. We're having a little bit of difficulties here. I hope that helps. I hope that this fixes the problem. Fantastic. Hello to all the traders out there. Thank you all for your patience. Once again, today is a great day of learning, and I'm thrilled to see all of you here. Today is going to be a very interesting topic. Nenad is going to present you with something very interesting later, but before we all do that, I wanted to take a little detour and speak to you about something a little bit different. First of all, here's all my contact details, my name, my email, my phone number, and my Skype. You'll be more than welcome to add me on Skype to ask any questions you would like, to give me a call, or even Google my name. Once you do that, you will find my LinkedIn account, and you will be more than welcome to add me on LinkedIn also. Today I wanted to talk about something different. Before we go ahead and start with today's webinar, let's make a small detour. How about I tell you a story? I would like you to all think, do you know a person who goes under the name of GP Master or a person whose name is Bill Kaplan? I have a Bill Kaplan here. Those two people created a company called Strategic Investments. Despite its name, this company did not deal with investments per se. What it did, it recruited MIT majors and taught them to play blackjack. Some of you have probably seen a movie called 21. It is not historically accurate, but the idea is correct. MIT students are taught a mathematical strategy and are able to win big in the casino. All that also involves romance, betrayal, and bulky security guard who takes you to the back room, which you only leave with no money and a broken nose. The strategy mentioned in the movie is rather simplistic. In reality, it's a lot more complex. The recruitment process involved choosing one great student out of hundreds. The chosen ones were great at making decisions under pressure and were bloody good in counting and analyzing. But the idea remains correct. Using advanced mathematical skills, MIT students were able to make profits playing blackjack over a very long period of time. And most importantly, those profits were stable. Blackjack is a casino game, and therefore the house has an edge. In 8-deck blackjack, the house edge is 0.85%. Best MIT students using advanced mathematical strategy, hours and hours of trading, ability to act calm under pressure, and stress, all of that allowed the MIT blackjack team to receive an extra 2% advantage on the casino. Countless hours of trading, dedication, and use of mad mathematical skills all of that went to generate the 2% edge. And the 2% edge was enough to secure high and stable profits. Now, if there's one similarity between Forex and Blackjack, it is this. Both Forex and Blackjack are zero-sum games. For someone to win, someone has to lose. Needless to say, people with an edge won. The ones that did not have an edge, they lost. So it's quite simple. If you have an edge on the game, you are most likely to win. If not, then you're most likely to lose. Right now, all of you are here listening to this webinar. Those webinars are long and the presenters talk about complex concepts. But still, you decided to spend your time here, and you did it to learn something new and develop yourself. Right now, you must think of yourself as those MIT students. You are working on your skills, and if you carry on long enough, you will be a lot better in analyzing and making tough decisions on the spot. Right now, you're working on your edge. Every hour you spend learning, listening to webinars, reading books, and trading on your demo account, all of that adds to your edge. All of that forms your competitive advantage on the Forex field. How big your edge will be entirely up to you. Just remember, if hard work and dedication allowed to make a profit in a casino game, just try to imagine for a minute what can be achieved on the Forex market if you work hard enough on building your own edge. It's been great speaking to you guys. I wish you a pleasant week of trading. I will now pass the microphone to Nenad, and he will carry on with this webinar. I'm pretty sure you will learn a lot of new and exciting things, and after you finish the webinar, you will be straight to trading with Abnormal Markets. Thank you very much for your attention, and God bless and good luck with your webinar.
Thank you, Mikhail. So we can continue with our webinar. Nice to know how you can build your edge in Forex trading. That is always what I was talking about. It's, guys, when you trade Forex, when you enter the market, you have 50% chance of winning. But when you build your own strategy with proper money management, with a good mindset, and knowing the Forex market, you can build your edge to 80%. 70-30 is really great. So I think that we will also have a webinar about money management. One of our next webinars will surely be money management, and I will be really glad to teach you how to do proper money management, because that is very important. So today we're going to talk about basic chart patterns, and I will show you how to trade most of those patterns. So let's start with our agenda. What are chart patterns? Why do they appear? Basic chart patterns and how to trade it. So this is what I will be talking about today. So what are chart patterns? There is a basic definition of chart patterns, and that is the purest definition of all. Chart patterns are reflections of price action in a given time. That means that chart patterns are reflection of the pure price on a given time frame. So they can appear even on 1 minute time frame. But of course, we don't trade patterns. I personally don't recommend trading patterns lower than 15 minutes time frame. So if the pattern appears on a higher time frame, it's more valid than pattern which appears on a lower time frame. So it's a pattern which is formed within a chart when prices are graphed. To have a chart pattern, we need to have a platform. My charting platform is MT4. I know many people who use other platforms for charting, but for me, MT4 is really enough. I like it. Chart patterns are used in technical analysis. They're either a reversal or a continuation signal, and they can be used to project price action and to react. So what does that mean in a simple sense? We use chart patterns to give us either a reversal signal or a continuation signal. They also are used to give us exact stop loss and exact target. So I can say that more than target, they're used to react. And if you followed my analysis today, I showed you on Admiral Markets Facebook page, Admiral Markets blog, Serbian blog, and Forex Factory, Spider's Den, my personal thread. I showed you how to use, for example, head and shoulders pattern. And if you saw the price movement after the news, you saw that the price jumped to the level where you could enter and subsequently made some, I think it was 25 pips, which is very good because we have London is on vacation today. So 25-30 pips on a low volatility day is great stuff. So today we had a head and shoulders pattern. We shorted just at the top of the right shoulder. If you follow the analysis, you will know what I'm speaking about. And after that, subsequently, the price fell down. So this is the pure price action. Okay, you wait for the price to reach a certain point, and then you open your order. And that is done without any indicators. So you can use stochastic, you can use other indicators to show you, but you know, chart patterns are the indicator for itself. It will give you an edge in trading. It will give you a right way, a right tool to trade. Because using chart patterns, stops are smaller and target profits can be bigger. But either way, you can scalp it. If you don't want to go for full price projection, I am always eager to say go scalp it. It doesn't matter if it's 5, 6, 7, 10 pips. Most of us work with some slight leverage. We don't do 1-to-1 leverage, right? So it's good if you scalp it also. So why do they appear? Chart patterns appear naturally on the chart. They appear naturally. So they are reflections, as we already said, they are reflections of price action. So by that reflection, we draw imaginary trend lines. And using those junction points with those trend lines, we create patterns. The patterns are already created by price, but we need those trend lines to connect to junction points and give us a clear picture. So triangles and flags appear during indecision, accumulation, or distribution, excluding flat top and bottom ascending and descending triangles. So we need to know what sort of patterns appear during indecision, and that is accumulation phase, or distribution phase, and that means trend. If you know 4 market cycles, you know that every market cycle begins with accumulation. Accumulation is positioning in Forex market. You know when price is accumulating, it's usually around 10, 11 GMT to 1 GMT, just 2 or 3 hours prior to US Open. So that is the phase of accumulation. Traders are positioning themselves. Accumulation phase also starts, let's say that big guys are positioning themselves before the trend starts or during the break of the trend. So they gotta build market position of several $100 million or $1 billion. So to make it happen, they have to do that over several days or over several hours. That means that they either create a triangle or, for example, a flag. So due to their large size, price will sometimes go against the position. So if they are building positions with a trend, a flag is created. So each time they place a position in the market, it goes against the position, so the market retraces. You don't need to be afraid of retrace. For example, today I shorted euro maybe a little bit earlier. I shorted it around 33.70. And when I saw the price moving to 75, 76 prior to news, I knew that it was retracement. It didn't deceive me saying that that was a change of the trend. It was just a pure retracement. It was a small retracement. So that was not the problem. Don't be afraid of retrace. So for distribution phase, when, for example, when big boys are done with riding the trend, we will normally see some ranging patterns. And those ranging patterns, they use it to load off their position. If there is a runaway market against the trend, it normally means that they try to immediately go out of their position due to some fundamental shifts. That creates large volatility. You usually notice that during the news. So we don't trade chart patterns during the news. 30 minutes prior and 15 minutes after the news, or maybe if the news are very, very heavy, there can be 20 or 25, 30 minutes. We don't use chart patterns for trading. Chart patterns are normally used in accumulation phase. So to build a position and to react after the distribution has started. Distribution is the second phase of a market cycle, and that indicates markup trend. After the distribution, there is markup trend. So usually there is trend, and after the trend, you know there is always a retracement. So markup, markdown, accumulation, distribution. Chart patterns reflect traders' decisions. And you can use, because there is major trader's decision. Chart pattern would never be printed on the chart if it wasn't for majority of the traders. So majority of the traders print those chart patterns, which we see it on the screen. There are also patterns called harmonic patterns, but we won't do that. I'm not an expert for harmonic waves. I don't trade it, but just to mention it, we will concentrate on, well, on those natural, standard, classic chart patterns. So this is what we are going to do today. Basic chart patterns. I will show you the examples of each of them, and I will show you how you can trade it. So we are going to go with symmetrical triangles, then we will switch to flat top triangles, then we will go with flat bottom triangles, rectangles, flags, pennants, head and shoulders, or inverted head and shoulders pattern. There will be also a wedge. I will show you a wedge, bullish and bearish wedge. So let's, before we start, I will switch to pointer, and I will show you symmetrical triangle. This is basically a symmetrical triangle. Flat top triangle, you will see it on the chart. Flat top triangle, as name speaks for itself. They have flat top, for example, and descending or ascending pattern. Or it goes like this. It's hard for me to draw with mouse. So they always have flat top. Flat bottom triangles have always a flat bottom. That is why they are called flat bottom triangles. Rectangles are normal rectangles. Normal rectangles. Flags. You know what flags are. Flags, pennants, wedges. I will show you all of that. Head and shoulders, inverted head and shoulders. So these are all patterns which appear every day on our screen, and I prefer it to see it on higher time frames. I prefer to see it on higher time frames. This is example of, if you know, we are talking about symmetrical triangle, and it goes with my red levels. So I usually want to see that happen in consolidation phase. So let's say we are trading it on 1 hour or 4 hour time frame. For intraday trading, I suggest 1 hour time frame. 1 hour time frame is good for trading intraday time frames. It's also good for scalp trades. So you always can profit from scalp trade if you're not sure whether the price will go for a full extension or it will reverse. But usually after the break of some of these sides, the price will go in desired direction. So we see that we have here an uptrend. Okay, this is the point of the change, right? This is turning point. The price has been triggered by fundamental shift, fundamental news. You see how the price reacted, creating this big black momentum candle. Then if you followed my last webinar, you know how you can trade this big candle. You can trade it by drawing a Fibonacci. This is 23.6 retracement. And you see 23.6 just continued price to the downside. It pulled price to the downside. After the beginning of a new trend, and that is downtrend. Okay, this is trend shift, this is confirmation, this is retracement, first swing in downtrend. After the first swing in downtrend, we see that the price has been consolidating. And the price is always consolidating into a triangular shape. This is symmetrical triangle. This is the upper side, this is the lower side, and this here, this part is called vortex. It's called vortex of the triangle. So it's the pinnacle of the triangle. We usually wait for the price to break close to the vortex of this triangle. So we wait for the price to break somewhere around there. As you can see, the price has broken to the downside, retested it, and then subsequently went downwards. So how you can trade this standard symmetrical triangle pattern? This is how I do it. I wait for the triangle sides to appear, and then I wait for the price action into the triangle. When I see that the price is closing, it's nearing the vortex of the triangle, let's say around here, it's vortex of the triangle, it gives also an angle, right? This is an angle. And then you see the price is closing to the vortex, then I wait for the preferred momentum. If I see that the price is in downtrend, as is this example, I would like to see the price breaking to the downside. Okay, I want to see price breaking to the downside because we are in a symmetrical triangle, in accumulation phase, in just waiting for the next swing in downtrend. So we know that this is downtrend. We have higher high, a lower high, and lower low. This is the change of direction here. So we don't have an uptrend. The trend has started here. It made a swing to the downside, and now the price is retracing, waiting for the next swing. Okay, the price has penetrated in this point. It's penetrated the triangle. Then it went down. You see how the price went down. The first thing, you can be a trigger happy trader to trade the first breakout of the price. So you can try to trade immediately after the triangle lower side has been broken. If I do that, I go for a scalp trade. Or you can wait the price to retrace and retest the lower side. This is the point of retest. So let me make this clear. This is the breakout, this point here. Then the price went down, and after that it retested. The retest was just at the lower part of this triangle. So the first thing, you can trade immediately after the break, but the sure thing is breakout, pullback, continuation pattern. You know that if you follow me, you know that I usually trade this pattern. Breakout, pullback, continuation. This is breakout, this is pullback. You zoom into lower time frame. And continuation is after the break of this spot here. So continuation is after the break of this spot here. but the price first needs to retest the lower side, then it continued to go down. So you see the retest and then continuation after the retest. And the price went to the next level, and then it reached the next level and very next level of support. So this is all downtrend. You see how the price is consolidating. Downtrend, downtrend, downtrend. So this is retracement. This is retracement. And this is a triangle which appears in consolidation phase of the market. Oops, sorry. I don't know what, oh, here, yeah, I skipped a lot. Okay, here, next slide. Again, consolidation in downtrend. Just let's say we are trading cable. Cable is usually more volatile than its counterpart with the Euro USD. So, how we trade? Usually, trading cable is a bit different. That is why I get this example. It's a bit different than from Euro USD. We also have this sideways consolidation triangle, but usually cable is traded at the first breakout. Why is that so? Because cable news, if you follow the cable news, you know that the cable news goes in one direction. When there is cable news, when there is Euro news, the price usually goes like this, like this, like this. It has whipsaws. You know that. And cable reaction to the news is this. It's either like this or either like this. So it's the opposite way of trading Euro. The cable gives us usually strict orders. And usually cable don't have those whipsaws that are characteristical for Euro USD currency. You know that. I will answer all of your questions today, don't worry. So, when you see the cable, and this is cable example, you can place your pending order few pips below the triangle if you want to trade cable news. Because, as I already told you, there are no whipsaws like Euro. Cable goes up or it goes down. So, this is how I usually do with the cable. I can place a pending order, or I can, if I'm fast enough, which I usually am, I can trade it manually without pending. I use market orders mostly. So, when I spot a triangle, and this is downtrend, you see how the price is reacting. This is downtrend. I would like to see the price penetrating 2 or 3 pips below the low of this symmetrical triangle. So, no, I will show you the rule. Don't worry, don't worry, Adrian. This is, but just have in mind, this is 1 hour time frame. This is 1 hour time frame, and this trade particular could have given us 80 pips, 70 pips, just by using this pending order or market order 3 pips below the low of this lower side. You see, the rules are not broken. You see how the candle penetrated straight down. And after few or 3 hours, 1, 2, 3, 4, 5 hours, right? After 5, this is 6th hour candle. The price went up to retest this part of the triangle, right? The price went up to retest it. And the continuation was below the low of this breakout candle. Now I think that this is very clear to you. This is the first breakout, which is usually very tradable. And this breakout, I don't go for 60, 70 pips. I usually go for 15 or 20 pips of the breakout. But this trade could have got us around 70 pips. And after the breakout, you see how this lower side has been broken, and this lower low, the lower part of the triangle is also broken. The price went down in one direction, then 6 hours after you see the retest. So you can make another entry at the break of this breakout low. So this part here is called breakout low. We trade breakout pullback continuation after the candle has retested it and broken subsequently the breakout candle's low. So this is breakout candle's low. So now it's very clear how you can trade symmetrical triangles and how you can trade it just after the news. So the breakout, you can trade it like this, placing the trade just below the low of this lower part of the triangle, or you can wait for a retest. Here is the retest and continuation, which is the breakout low, breakout candles low. Okay, now we have on Aussie, this is a good example on 15 minutes time frame, which is also good enough to trade. I saw a question, is 15 minutes time frame good enough to trade it? Yes, it is. I don't recommend trading 5 or 1 minute time frame. A 15 minutes time frame is tradable by itself. You don't need to zoom into lower time frame. If you use 1 hour time frame, you can zoom into 15 minute time frame. If you use 4 hour time frame, you can zoom into 15 minute time frame. Also, if you use 1 hour time frame, you can zoom into 5 minute time frame just to see if the part of the triangle or the other pattern has been broken. So let me guys point this clear. Only trade lower time frames if you're using multiple time frame analysis. What does that mean? We can trade this pattern. All patterns are tradable on 15 minutes time frame and more, right? If you use 1 hour time frame, you can zoom in 5 minute time frame to see, let's say, that this part of the triangle has been broken. Or you can zoom into 15 minute time frame to see if the part of this, let's say, triangle on 1 hour time frame has been broken. So you just want to see a lower time frame, 5 minutes, to see if the side of the triangle or the prior low has been broken. You don't trade it. So if this was 5 minute time frame, I wouldn't trade it. But because this is 15 minute time frame, it's tradable by itself. You don't need to zoom lower. Also, if you use 4 hour time frame, you can also zoom into 15 minutes time frame to see if this part of the triangle, or I'm talking about this example, it has been broken. I prefer 1 hour time frame and I prefer 15 minute time frame because I like to scalp. I really like to scalp because sometimes when market is not very volatile or it's volatile a lot, I really like to scalp. You know, I don't like this price action like this. This is very unnatural price action. But you can also scalp that. You can also scalp that if you know how to do it. So these chart patterns, you can also scalp it. Don't worry if you don't go for full retracement. Just scalp it. This is how I would trade this pattern. And I will show you how you can also do it. Okay, here we see that there is a flat top ascending triangle. This triangle usually signs the continuation of this part, uptrend, right? But if we see that 15 minute time frame, and this indicates 1 hour time frame, you see the candles on 15 minutes time frame, lower high, lower low, lower high, lower low, lower low, lower high. So this is downtrend, right? So we see that triangle has been formed a downtrend. I would like this top to hold because we have 1, 2, 3, 4 quadruple top here. Or we can say on 1 hour this is double top. So flat top triangles are usually formed by double tops. So I want this part to break. So this is how I would trade it. I would probably trade the first breakout of this triangle because stops are very small. Stops are usually placed just above this flat top side. So if the price goes to the upside, well, we will lose the trade, but we won't lose much. This is 15-minute time frame. This is tight stop. So I would like to see the price penetrating to the downside. So the price is indeed penetrating to the downside, but I needed the price just to retest this lower part of the triangle. After the retest, I would place my order around there. So I would go first for a scalp trade. I would wait, and I would probably close my scalp trade around there because I see that this is, well, this is a strong support, right? It has a tweezers pattern here, and it went to the upside, so this is support. I would close my trade around there, giving me, I don't know, 15 pips. But then I can see that the price moved up and then broke to this low. So I would place another trade at the break of this low. Okay? And I would drive it somewhere, I don't know, somewhere to the next support, where I see the support. If I see that the big support is there, I would drive it to here, to the downside. So there is two ways for trading the pattern. First, you can go with the first breakout, closing at the very next support, and then you can open another trade if you see that this support has been broken. Or you can wait for a retest and go for the full price projection, which is the height of this triangle. So the price projection goes right to the downside where the price has been consolidating. So how to calculate full price potential? By adding this number of pips, by adding that number of pips to the breakout of the whole triangle. Right? But we don't know if this will go to this support and jump down where we will lose a trade, or this will go down. And now maybe I differ from most of analytics and traders over the internet, but this is my way of trading, guys. This is my way of trading. I have my own way and I'm happy with it. So this is, again, for you who missed it. I would place a trade at the break of this triangle. I would drive it around there. I would close the trade. Then I will probably see some reaction to the upside. I'm cautious. I don't open a trade yet. And then next trade will be at the break of this low. So that is how I would do it. Because I would be probably afraid if the trade happened to break out around here and then it goes to the upside. And that frequently happens. If you trade every day, you know that frequently happens on your charts. Market is just like to grab your stops and then proceeds in your favorite direction. So that is my way of safeguarding my account. See this support, and then it goes down, and afterwards it retests this triangle again, and after this it's breakout, pullback, continuation. And also you can see that there is M pattern. You can see that there is M pattern. This is M. See? M. How you trade M? By breakout of the second point. 1, 2, 3. And you trade by the break of 2. So this is how M is traded. W is bullish. 1, 2, 3. You trade it by the break of 2. It's called M1, 2, 3 reversal pattern. And it's also called W1, 2, 3 reversal, because we trade at the break of 2. At the break of 2. So this is also M pattern in ascending flat top triangle. It's easy, right? It doesn't, you just need to get on used to this naked trading. You would see how that can be real good. Now we have flat bottom descending triangle. When I see flat bottom descending triangle, I like to see price action to the downside. Why? Because this descending line is giving us direction. This is giving us direction. And there is a flat bottom. So usually after the break of this flat bottom, vigorous price action will appear. You see the price has been in uptrend, right? This is uptrend. Now we see small head and shoulders around there. Here is shoulder, here is head, here is another shoulder. This is not ideal, but we can see that the price is turning. We can draw a trend line around there. You see a trend line. So you see how the price reacted. It went down. So this is a change of the trend. Now what we do, we want to see a pattern. At the first sign of the change of the trend, we want to see a pattern. This is where we see a pattern. Flat bottom, descending triangle. So this is very easy, right? This is a blind trade. You don't need to be an expert for this kind of trade, guys. You really don't have to be an expert. You see? So triangle patterns can sometimes be reversal patterns, but they are normally seen as continuation patterns. So this is a sign of continuation. I wouldn't like to see the price going upside and bouncing off this descending trend line, because that is not normal for flat bottom descending triangle. What is normal for this flat bottom descending triangle is that the price breaks to this bottom and go down. How I would trade this pattern? Very easy. You see this? I would like to see the price break. Not just this bottom. I would like the price to break to this hammer here. So if I see this, okay, the price has started to move. It's good. Immediately upon a break of this, I would place a scalp trade. Right? And then you see what happened. The price went down without almost any retracement. If you wait for breakout, pullback continuation, you would not get it on this trade. Again, what is the time frame? 15 minutes. 15 minutes is very good for trading intraday and after the news when there is a big volatility. You can trade it after the news when there is a big volatility. So this price action is probably triggered by USD dollar fundamental news release. I presume by looking at this chart that this was triggered by news event. So you see that the price has formed down descending flat bottom triangle. You wait for the price to break this part of the triangle, and for better confirmation to break this level, and then you can proceed with your trade. If you see, I will answer Adrian just in seconds. If you see that the price is proceeding to go further down, you are good to close it just around there, or just around there, because they are also supports. You see, those are supports, so you can close it around there. The answer: how do I know if there will be a breakout, pull break, or a trigger happy trade? Well, I don't know, but usually what happens in Forex market, after the break of previous strong support or resistance, price will collect some stops and go in our desired collection. Would you take it into consideration if I told you that today I made 3 pips on Euro USD when 83 broke to the upside? First I had a short trade, and I got some 10-15 pips with my short trade because there is not much volatility. After the news, price broke through 80, 81, and that was a flat. I think that was a double top. And after the price broke to that double top, I was long. So I was long. It was very, very good to have that trade. So I was really, if you ask me if I would trade it, I would trade it. I don't know if it will continue to the downside, but I would trade it. I would sure trade this pattern. Why? Because you see, this is very strong support. And now switch to a higher time frame, and you see how long this support held. So these are all 15-minute candles. You see, this trade was good for maybe a day. This support was really, really strong. Of course, after the break of this strong support, stops are collected. Stops are collected to the downside, and then you see how the price reacted. So Adrian, I would always like to see a break of this low to trade it. Same as 33.80 today. I went a little bit higher. I went at 86, but I closed after 4 or 5 pips because I saw that there was no momentum to the upside. Also, my analysis showed that the price is bearish. So why would I wait for whole price projection, 34.10, right, or 34 level? I saw that the price was rejected a couple of times of the 33.90, and then at the third, I think, attempt to break 33.91, it happened to break to 33.94, and then I closed because my analysis showed that the price is bearish, and I just wanted to exploit that breakout. And now you understand what I'm talking about. I like those breakouts of those strong supports. If, for example, if there is only a few candles apart, let's say this candle and this candle, I'm not sure if I would trade the breakout to this because there are not many candles in between, right? The space is not wide. But look at this space. It's very, very wide. This is 15 minutes. This is not 1 minute time frame. So we can say that this support is very strong. Also, we didn't see a close of this gap. You need to be aware of all instances on your chart. You see a gap here. It hasn't been closed after the price went up. So this was the chance for the price to close the gap. And it has closed the gap and proceeded further down. So this is, I think, this was very strong support, and there was a gap. So the presumption is this will go in our desired direction, and this will surely close the gap. So I think that this will help you. So, well, I like to see those trigger happy trades, but I don't go for many pips. Also, you need to know when to take those trades. So don't take it if there is a small space between those candles. Let's say we are trading on 15-minute time frame. I don't want to see this is very low for me. I want to see at least 3, 4, 5, 6 hours of action, at least. So if this was 1 or 4 hour time frame, let's say, this could be good for trade. Also 1 hour time frame, because there are 1, 2, 3, 4, 5, 6, 7 more than 12 hours of price session not breaking the support. Okay, I think that is very clear now. Next pattern is breakout pullback continuation. I already showed you how to do that, but you can see this on zoomed out screen. You see here that we see that the price has formed a descending flat bottom triangle. It's not a perfect flat bottom, sorry, because this candle hasn't made, for example, like this. But I see my red level. For me, it's enough. I assume, because the price has touched this level, that this is a downtrend trend line, and this is indeed a flat bottom triangle. So this is, as you can see, breakout, pullback, and continuation was at the break of this point. So breakout, pullback, and continuation. See the continuation. This is 1 hour time frame. So you can also scalp it, 10, 15, 20 pips. It's good. Breakout, pullback, continuation. If you want to go, for example, with more profit, you can go for breakout, pullback, continuation, and after some 15 pips, you can place your stops to break even +1. So you get some small profit out of that trade if trade retraces. Rectangle. Also, rectangles are very common in consolidation markets. For rectangle to be confirmed, we need to see double top and double bottom at least. We need to see double top and double bottom at least. This is a sort of double top. It's not perfect, but you can see also we have double bottom around there. So when we pull the charting tool, we can see that this is a rectangle. This is downtrend. This high hasn't been broken, so we assume that the price is still in downtrend. This is M pattern, right? See, M. See? And now how do we trade it? We want this low to be broken. You see how the candle broke without any retrace. And this is momentum, black Marubozu candle. So again, happy trigger trade, right? It would be good. After that, the price retraced to 50, let's say, % of the fib of this candle, and it went down. If you remember my previous webinar, when I talked how to trade those candlestick patterns, I told you that you can trade those momentum candles. How I trade it? Very simple. You wait for the candle to appear, then you wait for after it closes. You see that this is a pure momentum candle. You draw your Fibonacci from this side to this side, and you will get from the top to the bottom, and you will get those levels, Fibonacci retracement levels. 38.2, 50, 61.8 are levels for your trades. So this happened to go around 50% of fib, so you could short it, and you saw what would probably happen. You would be in very, very good profit. So the first chance for this trade is to trade here at the breakout of this low after this rectangle. The second chance is to wait for retracement and place a trade around there. And the third chance is to trade around the break of this breakout low candle. So breakout low candle can be traded by placing a pending order or market order few pips below it. So this is not hard, right? Flags. So what are basically flags? Flags and pennants are short-term continuation patterns that mark a small consolidation or a retracement before the previous move resumes. These patterns are usually preceded by a sharp advance or decline with heavy volume and mark a midpoint of the move. as you can see on the chart, the flag pattern is encompassed by two parallel lines. These lines could be either flat or pointed in the opposite direction of primary market trend. And these are the examples of that claim. This goes, you see the flags, they go in contra direction. We are in downtrend. You see 4-hour time frame. This is heavy downtrend, guys. But don't be deceived. Those lines are perfectly respected. You see how those lines are perfectly respected. The price is broken to this flag. You can trade the break of the flag. Again, the break of the flag. Of course, zoom into a lower time frame. For example, 15 minutes. And you would probably find breakout pullback continuation. For breakout pullback continuation trades, we need to zoom into 15-minute time frame to see it. Or if we trade pattern on 1-hour time frame, we can zoom into 5-minute time frame to see breakout pullback continuation. Is that clear? So we wait for the flag to break. We can be a trigger happy trade, but because this is 4-hour time frame, I recommend breakout pullback continuation. We zoom into 15-minute time frame and see we probably have on 15-minute time frame breakout pullback continuation around there. And we would place our stops just above 15-minute candle high. So trigger happy trades, you can do it on 15 minutes time frame. But for those kind of trades on a higher time frame, I recommend breakout pullback continuation pattern. You see how the price reacted to this flag? Again, it broke to the downside. Then we have a triangle, and then it again broke to the downside. All of these lows have been broken. You see, all of these major lows, supports can be broken and are broken. So you could trade it at the break of this pattern and also the break of this previous low. So these patterns are traded as breakout trades. And if you now listen to me, you can demo it until you are successful with your trading, just trading those breakouts. You can make some profits. Let's see another example. Now we see a pennant, again a pennant or a flag, but we also see a wedge. You see a wedge pattern. Wedge is very, very close to I can say a triangle, but it doesn't have a triangle as vortex. It doesn't have a triangle. Usually wedges look like this. So they are not triangles. Or they can look like this. They're very sharp. They can be sharp. Or they can look like this. But they also can look like this. You see? Wedge, and there is breakout pullback retest, and it went to the upside. It went to the upside. Also pennants here, you can see it. It's 4-hour time frame. Even if we zoom into 15-minute time frame, look at this. We can clearly see a retest. Retest to the downside. You see breakout, pullback, retest, and continuation. Here to the upside. Breakout, pullback, continuation here. Wedge, breakout, pullback, continuation there. You see, bearish wedge. This is bearish wedge. Don't be deceived by the look of this wedge. This is bearish wedge. This is bearish wedge. Not this, like this. And this is also bearish wedge. It doesn't matter. It goes to the upside. But wedge is a wedge. You see how the price reacted? It's like a channel. And then after it broke to this, retested, and went down. I would usually trade the first wedge if this is a lower time frame. On daily time frame, as I said, we use breakout, pullback, continuation trade. Breakout, pullback, continuation trade. Head and shoulders. As you already see on the technical analysis chart, and if you follow again my analysis, the head and shoulders formation occurs when a price is in the process of reversal, either from a bullish or a bearish trend. That is a characteristic pattern shape, and it's recognized as reversal formation. Head and shoulders pattern are noticed close to the supports. Or sorry, it can be also, it's not a good formulation, they can be also close to support and close to resistance. It doesn't matter. We need to see the neckline. The neckline is the most important part of head and shoulders. So it doesn't matter if the price is close to resistance. It's okay. If it's close to resistance, then, you know, it's better for us. We can short that. But if it's close to support, we also can short it, because it will usually mark that the price has still momentum to go down. What is important? The important thing and the most important thing is the neckline. The neckline is the most important thing, guys, on head and shoulders. Let me explain you. Head and shoulders formation consists of a left shoulder, a head, and a right shoulder, and a line called a neckline. The left shoulder is formed, now pay attention closely. Left shoulder is formed at the end of an existing move during which volume is noticeably high. After the peak of the left shoulder, there is subsequent reaction and price usually goes down to a certain extent, which generally occurs on a low volume. Then the price is rally up to form the head, and subsequent reaction downward is accompanied with lesser volume. The right shoulder is formed when prices move up again but remain below the central peak called the head and fall down near equal to the first valley between the left shoulder and the head, or at least below the peak of the left shoulder. Guys, neckline is drawn across the bottoms of the left and right shoulder. That you need to memorize that. A neckline is drawn across the bottoms of the left shoulder, the head, and the right shoulder. So we need those bottoms. That is a simple trend line, and we need to connect those bottoms. So what we should do then? We can short at the top, for example, of the right shoulder, because some stops are very small. Invalidation will come if this high is broken. Or we can wait the price to break to a trend line, a neckline, and go down. And if you remember, this was a live chart which I posted on my Spiders Den web page, Forex Factory thread, and also I posted that on Admiral Markets blog and Facebook page. And right, I was correct about that trade. This was a target zone, 28.85. It happened after the break of this head and shoulders neckline. It's a very sure formation if you know how to trade it. It's usually very, very precise. Also, we have inverted head and shoulders in a bullish wedge. You see, we have a bullish wedge. We saw a bearish wedge. And now this is a bullish wedge. You see how the price has formed a wedge, and then we see inverted head and shoulders. It's a double confirmation. Inverted head and shoulders. Again, we need to draw a trend line, and though that trend line goes around here. Let me make this a little bit more viable. So this is a left shoulder, and this is a head, and it goes like this. So the trend line is usually after the break. The neckline is usually after the break of this high or this high. So the price will break the trend line, retest the resistance, and go subsequently to the upside. And it happened. It happened later. The price is above 3.000. So this inverted head and shoulders is best spotted on the support. So I had triple confirmation of this trade. I had bullish wedge, I had inverted head and shoulder, and I also had my red level. So you see how the price, it was also good to long, just close to this red level, and or we could have traded it like this. We would wait for a neckline to break and we would go to the upside. So that is inverted head and shoulders. Now guys, I think that you now after this webinar you know what basic patterns are. For advanced patterns you can see our webinar with me and Chris talking about advanced chart patterns, but mostly I would trade these patterns. Those advanced patterns I usually don't trade, especially megaphone pattern. I really don't, or broadening top. I don't like that pattern. So these triangles and flags and head and shoulders are almost a sure way to go, guys. So let's say that we have finished this webinar. If you have any question, I will gladly answer now. Next webinar will be on Thursday with me and Chris. I have prepared a whole new set for September, so we will have also these webinars for new traders, but also experienced traders can join in. They can surely profit from this education. So I would like again to give thanks to Admiral Markets who is supporting us. Don't forget to like us on Admiral Markets Facebook page. I also post my analysis on Facebook page, on Admiral Markets Global blog, Admiral Markets Serbian blog, Spider's Den Forex Factory Thread, and Worldwide Investment Spider Den. I also use Twitter, but you probably will read all my analysis on Admiral Markets web pages and my thread. So guys, okay, you can no problems for those guys who have joined up lately. You can again watch this webinar. It's being recorded, so the Admiral staff will surely upload it to the site. So it will be possible for you to watch it later. No problems. You just go to webinar to admiralmarkets.com. Then you find education. Under the education there are webinars, so you will see it uploaded. So guys, thanks for listening to me. Thanks for joining us. See you on Thursday, and many green pips to you all. Bye bye and cheers.
The